know this has been a brutal month, so do you. And we saw that again today when the average just totally rolled over, with even the sainted NVIDIA giving up all of its gains, despite reporting an insanely strong quarter last night. But whenever the market gets hit, you know what? There are always buying opportunities, even if you think that we're looking at more downside once we hear from Fed Chief Jay Powell tomorrow at Jackson Hole. Hey, you can use this period of weakness to actually buy the best beaten down stocks at even lower levels. That's what we do around here. And that's why I've spent all week highlighting the worst performers in the S&P 500 for August. Not the best, but the worst, in order to point out my favorites. And tonight I've got 5 more for you. We'll start with American Airlines. I hardly ever talk about that one. Just riding the travel boom all throughout the spring and early summer. But it pulled back more than 23% from its highs in early July, including a 13% decline in August alone. Every airline's been under pressure because a bunch of new domestic capacities coming online. Just consumers are really starting to feel the pinch from higher interest rates. Boy, talk about deja vu. American Airlines always got dragged down by worries about its negotiations with the pilots union. Yeah, although the union finally approved a new contract earlier this week. Going to cost the company some money, but it could have been a lot worse for the business. Management seems to think that they can offset those higher wages because they didn't raise their full-year cost per available seat mile forecast yesterday, even though they said costs will be higher in the third quarter. I'm regarding it as a mixed story. All right, how about the industry-wide worries? I think they're somewhat legitimate, but these are domestic concerns. That's why I recommend circling the wagons around the airlines with the best international exposure. For that, that's United, Delta, and yes, American. While it's my least favorite of those three, American sells for less than 5 times this year's earnings estimates. Wall Street clearly thinks the numbers are about to fall off a cliff, or at least certainly not be met. So if they just hang in there, coming kind of close to where they are right now, I think the stock is going to go higher because it's got such a cheap valuation. Next up is another household name, Bank of America. GBTC is down about 11% in August, thanks to fears of slowing loan growth and new banking regulation. 11% is a lot for Bank of America. I think you're getting an opportunity to buy one of the best nationwide franchises at a terrific price. And I have not pushed this stock for a very long time. Remember, every time the Fed tightens, Bank of America instantly gets higher in net interest margins, making them more profitable. At these levels, the stock sells for less than 1.3 times its tangible book value, a huge discount versus its long-term average. I understand worrying about the smaller regional operators, but I'm not worried about Bank of America. All right, how about another that I don't talk about because these are coming down so hard, I'm talking about them tonight. Electronic Arts. That's the video game publisher with a stock that's down more than 12% month to date. Wall Street wasn't thrilled with their most recent quarter, not because of their actual results, which were solid, but because the guidance for the current quarter came in light. I'm more focused on the fact that EA actually raised its full-year earnings forecast. I think they've been doing pretty well, given that this has been a tough environment for the video game industry. Plus, you need to consider the scarcity value of EA now that it looks like Microsoft will be able to buy Activision Blizzard. Personally, I do prefer Take-Two Interactive. That's Strauss Zelnick doing a good job, the other big publicly traded video game publisher. But EA is certainly enticing down here, trading at less than 18 times this year's earnings estimates as a growth stock. Much cheaper than Take-Two. Then again, Take-Two might have a new Grand Theft Auto title coming out this year, and that's what'll coming out next year, and that's what a lot of people are excited about. Fourth is a lower profile company that I don't talk about enough. It's called Ball Corp. And they make metal packaging for food, beverages, and household products. Soda cans. Here's a stock that's down about 10% in August, and it's done almost nothing all year. The can business is tough in a world where aluminum prices are down 45% from their highs last year. Gives them less pricing power. So why bother with this Ball Corp? First of all, these guys operate in what's basically an oligopoly, meaning very limited competition. For example, they've got roughly 40% market share in metal beverage packaging across every region where they do business. That is staggering. A lot of price control here. Second, and more important, Ball Corp just announced, just now, the sale of its non-core aerospace division last week. BAE Systems is taking it off their hands for $5.55 billion in cash. That is an excellent number. They're planning to use the proceeds to pay down debt and buy back stock. Going forward, this will be a simpler, more focused story. I never really liked the fact that they put aerospace with the packaging business. I like aerospace a lot, but Ball never got much credit for its aerospace unit because it was buried within the packaging business. Finally, let's round out this series with one more beaten-down industrial name that we have liked and had on the show, and that is Cummins. That's the terrific engine maker, especially for heavy-duty trucks. Lately, I've been recommending Cummins because they've made major strides into hydrogen-powered engines, which is the long-term, well, let's just say, hope for big truck engines. It's going to take a long time for that part of the story to play out. But they've already doing plenty in hydrogen right now, building huge electrolyzers, which are machines that produce pure hydrogen by splitting up water molecules. When Linde announced a huge new green hydrogen production plant near Niagara Falls, they bought the electrolyzer from Cummins. That's where you have to go. Don't forget, there's a lot of federal money from the so-called Inflation Reduction Act going into clean energy sources, and it doesn't get cleaner than green hydrogen. Now, that said, Cummins reported not so hot quarter 3 weeks ago. Management sounded a bit more cautious than I like. Certainly some cautious more than some of the peers in the trucking industry. That's why the stock's been hit so hard this month. And the slow-motion collapse of China certainly hasn't helped either. However, I think the worries about the core engine business are already more or less baked into the stock, given that Cummins now sells for less than 12 times this year's earnings estimates. And I'm simply too excited about the longer-term hydrogen opportunity to get too worked up about management's conservative commentary on the heavy-duty truck industry. That's why I endorse buying Cummins on weakness. Here's the bottom line. While most investors have spent the week petrified of Jay Powell and what he will say tomorrow, we've given you 20, count them, 20 stocks that might be worth buying into any bout of weakness. So please check out these August losers and see if they might make a good addition to your portfolio. There are too many for me to point at right now and tell you to buy. That's how many great values there are. Mad Money's back in for the break.
Coming up, off price but on a tear? The discount retailers lighting up the market when we return.